Dennis Mitchell. We wanted to talk a little bit more about some retail realities in this country. Dennis, we saw Hudson's Bay, the oldest company in the country, that had a moment of truth and is now starting this liquidation, which is really going to leave just a half dozen stores open across Canada. But this is also a real estate story because, you know, traditionally, and you've covered these major real estate developers over the years that have had these landmark tenants like HBC. As you saw the news about HBC closing so many locations play out, what was going through your head?
Back to the Future. So it reminds me of Zellers in sort of the 2010 to 2012 time period. And you know, Zellers went bankrupt. They had a slew of stores. And what ended up happening was interesting is that the most valuable asset that Zellers ended up having was, of course, their store leases, where they paid well below market. Like we're talking below $2 a square foot in some places. So Zellers ended up selling all of their leases to Target for $1.8 billion, as Target sold some of them to Walmart. And so you can imagine RioCan and some of the other retail landlords benefited from getting a newer, stronger covenant, a more attractive retailer into their retail assets. So fast forward to today, HBC, this looks like the final nail in the coffin in terms of the near-death experiences they've had. Again, the most valuable asset HBC is going to have is their leases. And to put it in perspective, they pay on average below $5 a square foot, whereas market is north of $20 a square foot. So when they go to liquidate these assets, the first thing they're going to do is liquidate the leases. And there have been a slew of retailers from Europe and the United States who have entered the Canadian market over the last decade who will be looking to pick up some of these locations. But not all of the locations need to be retail. There seems to be an insatiable demand for pickleball in this country. So we'll probably see a lot of these locations. Yeah, we'll probably see a lot of these locations subdemised into, retail, yes, but in the basement, nothing wrong with having an Amazon distribution facility there for last mile fulfillment. The upper levels, you might see additions to food courts, you might see pickleball courts. But bottom line is the retail, the impact on RioCan is overdone in the market, and this creates an attractive entry point for that name in particular.
But let's get our heads away from the idea of, anchor department stores having to fill the void.
No, that's highly unlikely. I mean, one retailer that I look at is Decathlon, right? So it fits into that lifestyle sort of people looking after themselves, getting out more. They've entered the Canadian market and taken up significant space. Nike and Adidas have got more standalone stores. The Well was just opened by Allied and RioCan, and that's anchored by an Adidas to my chagrin, because I'm a Nike guy. It's anchored by an Adidas on the ground level. So there are tons of retailers who could take that space, but it doesn't have to be retail.
Okay. And then on the real estate investment trusts themselves, I saw the market was reacting to this as well. I saw some analyst commentary on Bay Street highlighting that RioCan has a reasonable amount of exposure to HBC properties. I think they said, I think Canaccord was saying Primaris as well. I would imagine those companies probably have the best intelligence on what's happening with retailers, even if, liquidation is a surprise at the end of the day, depending on where we were in the legal proceedings. But how should investors think about real estate investment trusts that have exposure to a retailer like HBC?
They should think this is an opportunity to get their hands on valuable space that was being leased below market. And so the end result should be just like Zellers 10, 12 years ago, positive in terms of long-term cash flow and long-term value creation. But I'll give you the numbers. RioCan's exposure to HBC is about 3% of net operating income and about 3% of cash flow per unit. RioCan does about $1.57 of cash flow a unit. They pay out $1.16 distribution. So there's over 40 cents a buffer there. If you take HBC out entirely and don't replace any of that income, costs you about 6 cents.
So don't think of this as, what's RioCan going to do? The question is, what's RioCan going to do?
Yeah, you have to look at this as short-term pain, and that pain will come in, there's going to be time and money spent to replace the tenants and redemise the space, and then you're going to get likely higher cash flow from a better quality tenant for the long term.
Okay, well, for the long term, I know increasingly you're looking not just at publicly traded securities, you're looking at the private market. So we're going to take a quick break, come back. Dennis Mitchell will talk about some of the other